If you don't know where the profits come from, then the profit is you. If you don't know where the yield comes from, well, then the yield is you. This refers to a statement from Safedin Ammous, and I think it's a very, very good summary of what investment is all about. If you don't understand where the profits come from in a project, let's say you invest in a company and you don't understand how the company makes money, well, then probably you are the one, you are the profit. In other words, you are the source of the profit for the company. If you do yield farming with altcoins, and you don't quite understand where the profit comes from, how does that yield work? Well, then probably you are the yield. Your investment is the source of the yield of the whole project. This is just another concise, poetic way to say that you're kind of being victim of a Ponzi scheme. Now, Safedin has a very sharp tongue, and he says a lot of things that are kind of true, but really are not helpful. Like, for example, the whole fiat system is just one big Ponzi scheme and things like that. I mean, yes, Safedin, I agree. Maybe that's true, but what can I do with that? That's the system I live in. But nevertheless, I think the important lesson here is if you don't understand where the profit comes from, then the profit is you. In other words, don't invest. We just decided to exit one of our positions. I'm going to go into more detail a bit later, but one of our positions is actually exactly like that. It's a company that has a lot of promise and looks interesting. It's the company's in the syn bio space, but they don't making any money. And there's really after almost 3 years of having been invested, they just keep not making money. Their growth, their sales are growing, but they're not making money, and we decided to exit. So it's one of those situations where you have to bite the bullet, and hopefully we can actually get out at even break even, so we haven't even lost money on that position. This is the Not Even Wrong podcast. It's November 15, 2022. This is Krim Delco. For the day, the fund is up 70 basis points. The market is up 10 basis points. For the year, we are down 53.1%. The market is down 14.4%. We're underperforming by 38.7%. So what am I talking about here in particular? If the profit is not clear, then maybe you are the profit. This is one of the most important investment lessons you can learn as an investor. The purpose of this podcast is to give people a sense for what it feels like to run a hedge fund. So there's nothing more important than understanding what to invest in and what not to invest in. I've said it many times, the only degree of freedom we have as investors is really to buy something and hold on. That's the only way we can generate wealth. Trading is not an option. All leverage, all of these kinds of things, they're really not, I mean, they can enhance things, but owning the right stock is really what generates wealth. So it's our job to try to find those stocks, and when we're wrong, we get out. We have that degree of freedom, of course, but it's not what generates wealth. It's just what avoids losses, and this is a good example. If you have a company like this particular company that we're going to exit tomorrow, that has had good sales growth, 50%, 30%, 50%, like quarter after quarter, but not making any money, there's really 3 reasons why that could be the case. Let me start with the best reason. It could be that the company is just continuously building a massive infrastructure and therefore reinvesting all the sales dollars into building a massive infrastructure that eventually will throw off a lot of money. Examples of that are Tesla and Amazon and the Golden Gate Bridge, and you go on. Oil companies are like that, at least in the old days. Although oil is a little complicated, because let's say Bitcoin mining could be something like that. So you build a massive infrastructure, you generate scale, you generate network effects, and then you reap the profits. The second reason you could be growing without profit is that you just don't have the unit costs in line. So that means that you can't produce a product or a service and sell it at a price with a profit. And this is a very scary situation. But because you're still growing, maybe hopefully you can get some operating leverage. So this is the sort of this middle way that we often hope to be in when we invest in growth stocks. And the third is the worst, where you're actually dumping prices to buy growth, hoping that investors give you a large sales multiple. And that's really the case when you don't understand where the profits come from. The profit is you. That's it. They're just sucking money from you and paying themselves nice salaries and all that kind of stuff. And they're really screwing not just you as an investor, they're screwing their employees, because most of them are paid in stock. And I think in this case, this stock after 3 years has not been able to show any meaningful growth beyond, in earnings and margins. It just has to, it makes you believe that it's unfortunately one of those cases, and then you exit. So this is a good example of admitting mistakes. Maybe it's a bit too late. Maybe we should have been sharper. It actually took a third-party research report that was very negative to kind of trigger this thought. But I have to say, also in the last couple of days, I've been following the FTX situation, and FTX is, on the one hand, not a surprise. If you take, it reminds me of WeWork. I haven't really looked into FTX too deeply, but now that I look in hindsight, it reminds me a lot of WeWork, a business that really is not very interesting. It's very competitive, very commoditized. I mean, an exchange per se is very commoditized. There's so many exchanges out there, and then the crypto exchange. There are other exchanges. Again, how can you really differentiate? How can you justify valuation? All these questions come up, and the answer is, well, if you don't understand where the profit comes from, then the profit is you. And in this case, unfortunately, for all the people that have put money in FTX as investors and customers, they've had to learn that that's the case. They basically lost their money, probably most of their money. So it was a scheme, a bad scheme. Maybe it was fraud. I don't know. This is not the place here. This podcast is not the place to discuss legal issues. And I'm not going to go into details what happened with FTX. You can find that anywhere out there right now. You will find the details. But here's what I want to say about this. It just makes you think that we really have to be careful. We have to be careful as investors. We don't have the safeguards. We don't have the SEC and the auditors and the accountants and Wall Street and all of these people, the media. They're just not there to protect you. You can't do it. Don't trust, verify. This is a big statement in the crypto space, and it's true. Now, how do you verify? Well, that's really what a hedge fund manager does. I mean, that's what a wealth manager, wealth creator, or whatever you want to call us, has to do. It's verify. Try to verify as much as you can. Of course, we can't get to the absolute ground truth. Maybe there isn't such a thing as an absolute ground truth. But there's a bullshit factor. There's a bullshit radar. And a lot of these kinds of things, they really exist. You can tell a sleaze quite quickly. You can tell a snake oiler. You can tell all these things. And I think we at Orange Capital Partners have been, fortunately, we've never been really badly hurt. And, it makes us think, even now, maybe we're wrong with Tesla. Who knows? Maybe that's a big Ponzi scheme and it will blow up and we will be poor. It's not impossible. I hope it's not, because we have a car, we have a product, we have a value that is provided, and we have a lot of safeguards, like sales of cars and the cash flow and all of these things. So the likelihood that Tesla is a Ponzi scheme or a fraud is very low, but you never know. So you really have to kind of try to minimize that probability. I guess what I'm saying here is that we've been incredibly focused on growth and disruption. The mission of Orange Capital Partners is to invest in fundamentally new concepts and engineering practices and generate wealth with that. We've never really talked about the other side of wealth generation, which is wealth destruction. And that's an important factor that needs to be discussed, particularly in a podcast like this. That, the purpose of this podcast is to give people a sense of what it feels like to run a hedge fund. But wealth can be destroyed. Wealth can be destroyed through fraud. So make sure you have a radar for that. And while one radar is sleaze factor, bullshit factor, the other could just be what Safedin Ammous said. If you don't understand the profits, then the profit is you. Just stay away. If a business can't explain to me how they make money, I mean, take, for example, all these tokenized projects now in real estate. And unfortunately, Mark Andreessen Horowitz invested in that WeWork guy who blew up already one company and now is going to blow up another one, where some sort of incentivized smart contract, tokenized crypto, real estate scam, I don't know what it is. In the end, it's going to end up the same way. Maybe a few insiders can make money, but most people will end up holding the stick. And that's unfortunate. There's the conversation of should people like that go to jail or not. I think we have a legal system that takes care of some of it, like fraud. If you use customer money as an exchange and speculate with it in a hedge fund, that's fraud. I think that you go to jail for that. But in general, if you tell people, look, let's say in this case, let's assume I issue a coin, I call it Crim coin, and I tell people, well, give me money, this coin is going to gain in value because everybody's going to start using it. It's going to be valuable and we can do something with it. And then people start buying that thing. And I use it as a collateral to borrow money and buy myself a nice house in Los Altos. And then I blow up. That's not illegal. And the people who gave me money are stupid and they should be punished. That's how capitalism works. So this is one line of thought. And this is just as a tangent to the whole legal question of what should happen to FTX. Again, if you tell people, listen, I'm going to be a custodian of your money and you can trade on my exchange, but then I use that money and trade with it, that's lying, that's fraud, and people should go to jail for that. But there's a fine line between stupidity and fraud, and I think the stupidity side of things should not be coerced with jail and incarceration, because that's how we learn as a society, hopefully. So anyway, that was just a tangent. Get back to what investment advice do we gain from all these, or what do we learn from this? Well, we learn, again, if you don't understand the profit, if you don't understand the yield of something, then maybe you are the yield, meaning your money, your investment money is going into the pockets of those who are building the scheme. And if you want to finance them, fine, but of course most people are not in the business of financing some young wannabe billionaire. They want to make money with their money, and they should. So to conclude, if you don't understand where the profit comes from, then maybe you are the profit. The corollary of that is that you should be very careful about understanding the profitability of a business. Making money is important. How much, what the valuations are, how much are you willing to pay for earnings, that's a different question. But let's start with making money. And by the way, cash flow. How about we talk cash on cash? I have this code with my partner and her father, doesn't matter, I need to not mention names, but her father, we always say, let's think about your father. And the father was a merchant. He was selling shirts and things like that back in the Middle East. And he was very simple. I buy something, I sell it, meaning I buy, things, I make something, and then I sell it. And hopefully there's a profit left. And if there's a profit, then that's my living. That's how the economy works. And there really isn't much more to it. And we can complicate it. We can make technology that is complicated. We can make even business models that are complicated. That's fine. We can innovate. Business models can be a bit more complicated. For example, we can have a freemium approach to something. We give stuff away for free, but then we start charging. Or we can price things differently. We can have different tiers of pricing, or we can have escalating or de-escalating pricing. That's fine, but there has to be a path to profitability, a path to cash on cash profitability. And if you don't see that, then stay away. So we at Orange Capital Partners have decided to get out of one particular position just because of that. Hopefully we can do that tomorrow. We will, of course, keep scrutinizing every investment that we make or potentially make. But I have to admit, over the last couple of years, we've been carried away. We've been carried away a bit. Cheap money has made us soft. Cheap money has made us not follow this advice, and that's bad. I'm glad we're still here. We're still alive. We're financially sound. And I'm thankful for that. And I want to take this opportunity to learn and become more agile. And in particular, when it comes to the money-making question. Because if you don't understand where the profit comes from, then maybe you are the profit. So you better understand where the profit comes from. Thank you.